right. I am going to get started with our masterclass series today with SILC. I want to thank all of those who are attending today. We're really pleased to have you. Our SILC masterclass is entitled Sustainable Investing, a Roadmap. And my name is Andrea Schmitz, and I am the president of SILC. So I wanted to go over a few course notes before we get started. So as many of you know, our goal at SILC is to integrate sustainability into accounting standards, legal frameworks, and investment decision making. This particular course runs from noon to 1:30 p.m., although we will likely be done about 1:15, at which time we'll have time for some Q&A. This is the third of 4 courses in a series. Folks who go to all 4 courses will receive the SILC course completion certificate. A video is available for the prior 2 courses, and I will put that in the chat. It's available on YouTube. And if you take that course, I will also give you the email, which you can send to let us know that you took it for the certificate. This course is also attendees are eligible to receive New York State CPE credits. And if you are looking for the CPE credits, please be sure to answer the Zoom pop-up questions that are going to show up as we discuss the course. They are simply going to confirm that you're attending. So they're very simple, just acknowledge and we'll move on. And then we'd like to have you put questions in the chat, and I will help sort of moderate the questions as we go. And as I mentioned, we will also have some time at the end for Q&A. So I'm really pleased today to introduce our presenter, who is a true expert in the field. Sakis Katsantonis is the CEO of Richmond Global Sciences. Sakis has extensive experience in ESG investing and research, ESG data sets and measurement frameworks. He previously co-founded KKS Advisors, a leading advisory firm instructing clients on innovative solutions to more sustainable business models and communities. And he holds a PhD in material science and engineering from the Imperial College in London. So with that, welcome everyone again, and I will turn the agenda over to Sakis.
Thank you. And I just, okay, let me share my screen. Thank you, Andrea. It's a pleasure. And thanks everybody for joining. Today's session, we titled it Sustainable Investing, Implications for Investment Accounting Practices, Legal Disclosures, and Assurance Compliance Activities. And I tried to build this keeping in mind 2 professional groups who I believe are increasingly being pulled into the center of the sustainable investing conversation, CPAs and attorneys. I don't know if there's a need for defining ESG with this class, but very quickly I'm just going to mention we're thinking about companies intertwined with environmental, societal, and governance issues that can span from the relationship and impacts of companies on the natural world, pollution, natural resources, exposures to exogenous shocks such as climate change, to social factors that cover people and institutions, both in the communities, but also in global supply chains, and governance factors talking about internal systems of practices, controls, procedures that the company adopts to govern itself. So if you're a CPA, maybe you've noticed that what used to be an investor relations or ESG team topic starts to intersect with areas you directly own. Could be valuation assumptions, impairment analysis, contingent liabilities, credit models, and now increasingly assurance. If you're an attorney, you likely felt pressure from the other direction. There is an expansion of disclosure regimes across jurisdictions, and I'll give you some numbers around that. Greenwashing enforcement, naming and marketing restrictions, fiduciary duty interpretations, and what I would say a widening gap between what firms say and what they can actually prove they're doing. So today, it's not a debate about ESG as a concept, but we're focusing on the operational reality. Sustainable investing is moving from being a product feature to being a regulated claim, and regulated claims have consequences. And we're going to focus on financial reporting and investment accounting, where ESG factors start to influence measurement, judgment, and disclosures, legal and regulatory disclosures, where the question becomes, what are you required to say and what can you defend? And assurance and compliance, which is the reality that information around sustainability is being pulled into an assurance paradigm faster than what organizations are ready for. Um, and I'm going to start with establishing who are the players that drive this transition, what is sustainable investing, what does it mean, and looking at what has happened the last 5 years, and things are evolving pretty fast. And I'm going to close with some what I could consolidate as practical implications for CPAs and attorneys and how this hits policies, controls, disclosures, engagement letters, and so on. So let's start again. I'm going to start building this up a little bit, but what I wanted to highlight with this slide is something important that sometimes it's overlooked. Sustainability reporting didn't become mainstream overnight. It has been building for decades, but the last 5 years or so, it crossed a threshold. So now nearly all of the top companies in terms of market capitalization report on sustainability. So it's no longer a niche activity, it's a default. And why did it become so widespread? At first, it was a story around a reputation and stakeholder management. Companies started responding to NGO pressures, employee expectation, and customer perceptions. But over time, this evolved into something more financially relevant. Organizations realized that sustainability reporting can do several things that directly interact with capital markets. First, they provide structured information around sustainability performance, and that could be on emissions, workforce metrics, governance practices, supply chain policies, and so on. Second, it improves the efficiency of capital allocation. The reality is that investors cannot price what they can't see. So the more consistent and comparable information becomes, the easier it is for markets to differentiate between firms, whether it's about risk, resilience, cost of capital, or competitiveness. Third, it creates a track record internally and externally. If you're a company that has 5 years of emissions data and you start setting some targets, then this is a trajectory that markets can judge. And trajectory can also become evidence, and evidence is what matters when claims start becoming regulated. And fourth, it creates a basis for engagement. Shareholders and lenders can engage directly with management on something more tangible than vague. So now thinking about pivot for CPAs and attorneys, as sustainability reporting matured, it stopped being purely narrative. It has started to become metrics, methodologies, controls, governance, external reviews. And this shift matters because now you move into the realm of definitional consistencies, estimation techniques, documenting facts, and potential misstatements. For CPAs, this is where also sustainability starts overlapping with financial reporting. And right now, it's not because sustainability metrics live within audited financial statements, although this has started happening actually in some events, but because they influence financial statement judgments. So let me give you an example. If a company discloses climate transition plans that imply major capital expenditures, those plans may affect asset useful lives or impairment triggers. If a company is disclosing major remediation commitments, again, this may affect contingencies, or they might disclose some dependency with supply chains that has associated risks. For attorneys, the same shift creates a different issue. Sustainability reporting is now a source of potential liability. Once disclosures are specific and repeated, they can become commitments in the eyes of regulators, investors, and plaintiffs. So, if a company, for example, says, we integrate ESG systematically into investment decisions, then someone might ask, what does systematically mean? What is the evidence? Who approved the language? Who controls if this is true? What happens if there's a portfolio exception? So while we're in this voluntary era, this might have been a reputational issue, but as we're becoming increasingly regulated, it can become a compliance and enforcement issue. So this story around sustainability reporting that companies are building is more than reporting, it's consequential reporting. Um, Now, let's start talking about regulators. And I'm going to pause here because I think one of the first questions has popped up, or at least I saw it popping up. I'll leave people time to fill this. Okay. So if we start thinking about regulations, regulatory regime has expanded not just in quantity, but in scope and in the mechanisms. So historically, it was narrow, like environmental compliance rules or soft, like voluntary guidelines. And what changed, especially around climate and sustainability disclosures, it started being treated as part of market integrity and investor protection. So regulators increasingly believe that if sustainability issues are financially material, then failure to disclose them or inconsistency in disclosing can create investor harm. And that's why you see a long-term upward trend in regulated policies, ESG-related policies and regulations. Some are mandatory, some are what they call comply or explain, and some are stewardship codes. Some are listing standards, and there's also disclosure templates. But across all of them, there is, I would say, a clear direction of travel, which is more structured requirements, more comparability, more scrutiny. Um, I do need to point out, given the audience in this call, that the regulatory demands have predominantly mounted in European and Asian markets, especially in the last year or so, where we've seen the United States pulling back significantly from some of the ESG-related regulations. But given how much exposure large companies have and investors to other markets, some of these regulations still impact companies based in the US. Uh, for CPAs, this regulatory expansion matters because it increases the burden on systems and controls, internal review processes, and sometimes assurance readiness. When regulators create these templates and technical standards, it forces organizations to define methodologies. And once these methodologies exist, then an organization needs to apply them consistently, document exceptions, manage changes, and so on. For attorneys, this regulatory expansion matters because it increases the disclosure obligations. And back to what I mentioned about different jurisdictions, it increases the complexity across jurisdictions and a potential enforcement exposure. And it changes the legal meaning of ESG language. And what I mean by that is in marketing terms, words could be vague. In regulatory disclosures, words become testable. Um, so if we move now to some more global developments on the regulatory side around stewardship, uh, together with the requirements for asset management firm to make explicit reference to ESG factors, we have what we call stewardship codes. Stewardship codes seek institutional investor transparency. And while they're not compulsory, they're increasingly viewed as a condition for asset managers to retain business. They are important because they frame responsible investing or sustainable investing as not just an investment decision, but an ownership responsibility. So the logic is that if you are an asset management firm, a pension fund, an insurer, you're not just buying securities, you are exercising influence. Therefore, you have responsibilities related to governance oversight, to engagement, and sometimes ESG integration. For attorneys, stewardship codes matter because they can shape fiduciary expectations, they can shape standard of care arguments, and the reasonable investor context for disclosures and conduct. And even when they're not strictly enforceable law, they can become the benchmark used by regulators or courts when assessing whether conduct was responsible. For CPAs, and assurance professionals, I would say they matter because they require reporting on engagement activity. They require proxy voting policies and outcomes, escalation decisions, and sometimes claims about how ESG factors were considered in ownership. And again, we have the documentation and the control processes that need to be in place. Again, there's differences in the regulatory environment in the US and Europe and the rest of the world. The depth and breadth of regulation with a focus on ESG varies. In the US, This has been primarily market-driven and largely voluntary. When it comes to regulators, the picture is a bit blurry, which with mixed signals by the SEC. At some point, the SEC opened the door to expanding the disclosure on human capital, while they established new and stringent shareholder proposal thresholds. They introduced some congressional bills in 2018 and 2019 on ESG and climate risk disclosure, but these were later revoked. In the European Union, very stark contrast. The regulation has been driven by regulators like the European Commission, that introduced mandatory reporting for certain entities. And these actions are part of a wide-ranging set of regulatory initiatives, which are now later stage, and they're under the EU Action Plan on financing sustainable growth that includes a regulation on reporting from the corporate side, but also from the investor side. Now, along with regulators, capital markets themselves, this is now self-regulating, created pressure through stock exchanges. And this is a powerful point, I would say, because stock exchanges act like quasi-regulators. When an exchange includes ESG reporting as a listing requirement, it becomes a market access issue. If you want capital, if you're a company that seeks capital through markets, you must comply if you want to list on that stock exchange. And that matters because it accelerates rapid adoption. Even if national law is slow to evolve, exchanges can accelerate practical change by conditioning listing or continued listing on disclosure practices. There are examples of such exchanges, big ones like the Euronext Paris and the London Stock Exchange, that have ESG reporting as a listing rule. In the US, currently, there are no exchanges that do have those requirements. At some point, NASDAQ in early 2020, if I'm not mistaken, they launched an ESG reporting platform, and they gave out some guidance as a support, ESG reporting guidance as a support resource for companies. Again, if we start thinking what's the implication for attorneys and CPAs, I think for attorneys is important because it adds another layer of disclosure review. Listing rules could require specific disclosures, specific governance arrangements, or periodic reporting obligations. For CPAs, it's similar pressure because it's almost like a financial reporting pressure where you have deadlines and control mechanisms that need to be in place. So if you remember when I started, I wanted to paint also a picture of who's who in the space. This slide is about the ecosystem of standards and initiatives that increasingly define what good looks like in sustainability reporting and sustainable investing. And given the rapid rise of ESG, there is a lot of disclosures that have become public and are subject to scrutiny. From an investor point of view, having comprehensive and comparable information on market participants and other stakeholders is important to be able to make any meaningful assessment. And this is where these frameworks and standards play a key role. They provide a model for reporting consistency and comparability. I'm not going to go through all the acronyms, but broadly, there's two categories. There's the frameworks that help organizations describe sustainability topics and management approaches and how to best report them. And there's the standards, which are more prescriptive, often aiming for consistency, comparability, and assurance readiness. One that I do want to emphasize is the presence of the IFRS foundation on the slide, which signals institutionalization. And because we know that if sustainability reporting can be housed within the same umbrella as financial reporting standards, the market will interpret that as a move forward toward investor-oriented reporting and standardized metrics. Again, you can kind of like infer some of the implications for professionals in the space, especially related to finance functions that deal with the mindset of materiality and hopefully external assurance at some point. What you also see on this slide is the Sustainable Development Goals. They're not a regulatory framework. I would call it a global policy framework, but they do influence corporate reporting narratives and a lot of the investor impact claims, which also goes in hand with product positioning from the investor point of view. Um, so if you want to take one key takeaway there is that the ecosystem is maturing, and with this maturing come some expectations of discipline. Maybe I should have started there, but what is sustainable investing when we keep referring to that term? And again, I think there's one more pop-up question. Um, I left it to later because I wanted to build the story of how things have evolved over time. But there's something that I do want to emphasize in this slide that as of now, there is no singular definition of sustainable investing at the national level or even at the global level. And there is a range of terms: responsible investing, sustainable investing, socially responsible investing, common ones. And this creates complexity because it makes it difficult for investors to understand exactly where they're investing their funds. There's policymakers like the European Union that attempt to unify these requirements on what can be classified as sustainable investing. But overall, the idea of sustainable investing or responsible investing is an investment approach that seeks to consider both financial returns and social or environmental benefits. It started with the exclusion or negative screening. It's in its infancy from the investment universe of controversial sectors such as tobacco, gambling, and weapons, but it has evolved ever since and differentiates from what could be considered as traditional investing because we're considered these factors in active investment decisions, either at the security or the portfolio level. So you have from the left-hand side everything from screening, again, excluding certain sectors, to moving to more sophisticated ESG integration, which is a more systematic approach where investors use ESG factors alongside traditional financial factors in investment analysis and trying to better understand how company manages some of these risks and opportunities. And then you have, as we move to the right-hand side, slightly different investment focus on thematic investing, where investors could select assets or themes, let's say climate change or certain sustainability challenges, and they invest in companies that try to address that challenge. For example, clean energy mutual funds or sustainable agriculture or emerging markets healthcare funds. Impact investing is the broader term for targeted investments intending to solve social or environmental problems. And it could also include community investing, where capital is spent directly to traditionally underserved individuals or communities, as well as financing that is provided to businesses with a clear environmental purpose. And then on the very right hand side, you have philanthropy, which is very different because the aim is not financial returns. Um, why am I insisting on these definitions? There is this practical risk driver here. If a term such as sustainable investing is not clearly defined, then different stakeholders will interpret the term differently, and then product claims become ambiguous, and enforcement often will focus on whether the claim was misleading in context. So sometimes these terms are used interchangeably, sometimes they mean different things. Again, the problem is when it's used by marketing, it could blur them, while regulation increasingly is trying to separate them. So for attorneys, definitional ambiguity is a classic risk zone. It can lead to misrepresentation allegations because what the product did not match what the investor thought the label meant. And for CPAs and assurance professionals, it complicates evidence requirements, methodologies, and comparability across products. So in sustainable investing, the definition is part of this control environment. So for example, if a fund is using negative screening, the question is what is being screened? How is it being applied? What are the data sources? What are the exceptions? If a fund will say we're using ESG integration, the question will be even more complicated. So how does ESG influence buy sell decisions? Is there a scoring model? Are the factors financial and material? Are they systematic? Is it just analyst driven? Is there evidence in investment memos? So if a fund is using impact investing, then questions are around measurement. How are outcomes being measured? How are they verified? Are there counterfactual arguments? How to avoid overclaiming impact? And this is why enforcement risk often concentrates in two places, where claims are very broad and hard to prove, and where claims are specific but unsupported by control mechanisms. So again, this spectrum is not just an investment taxonomy, it's a risk taxonomy. Now, if we move to the market evolution, so taking that framework and all these players, is there any money being invested in those assets? This slide shifts from definitions to market behavior. And over the last, I would say, 5 to 7 years, sustainable investing has gone through a maturation cycle. So in earlier growth years, there were more funds, more labels, more strategies, more marketing claims. And as regulatory scrutiny increased, the market began to tighten and definitions became stricter and more rigorous. Classifications became stricter as well, and some funds rebranded or adjusted strategies. Given what we mentioned a couple of times, it might not come as a surprise that Europe has led the way in terms of total responsible investing dollars under management. But even in the US, those numbers have tripled or more over the last few years. Um, a change in reported sustainable assets under management over the past 5 years may actually reflect changes in definitions and not capital inflows and outflows. So if a stakeholder asks, is sustainable investing shrinking? The correct answer is some of the change is definitional. So what qualifies has been narrowed. So this is not necessarily a bad thing. It's actually a good thing. For CPAs, the analogy would be revenue recognition or consolidation standards. You can't compare old numbers to new numbers if the definition has changed. For attorneys, this is important because definitional tightening is driven by enforcement risk, litigation risk, and this desire to reduce ambiguity. Again, going back to this spectrum that I was discussing and the definitional ambiguities there. Um, on the next slide, we're going to talk a little bit about asset flows. So if I wanted to throw a little bit of the history and how we got where we are, what we saw is that 2020 was a record-breaking year for ESG investment market, despite the pandemic. Different sources consider that a growing public awareness of the climate crisis alongside the disruption caused by COVID-19, accelerated actually ESG growth as investors looked for sustainable business models that can withstand market shocks, external shocks. But this flow exhibits great volatility as years go by. So at some point, and you can't see it actually, I realized there in 2021 we had a peak of I think 600 billion in USD in inflows in total global funds, sorry, with the broader market enjoying inflows that year. But then if we look at 2023, sustainable fund flows remained resilient with the broader market fund slowly recovering. But then in 2024, inflows into sustainable funds start shrinking while the rest of the market is enjoying a boom. And then we have 2025 where these outflows are reducing even more. There's many explanations why there. So parties, again, influence from the US in terms of a regulatory and a policy shift in terms of ESG. But a lot of these numbers have a lot more context in there. So for example, what you see in 2025, a lot of the outflow was redemptions by large UK and European institutional investors, shifting assets from pooled ESG funds into bespoke ESG segregated mandates. They wanted more flexibility to comply with all the strict definitions and regulations that are coming up. So they wanted to have more control in terms of what these ESG funds mean and where the money is being invested. But fund flows do tell you a story about market confidence and product demand. And I think a key message here is that these flows become sensitive to performance, sensitive to interest rates, sensitive to politics and regulation. And of course, during certain periods, they're driven by investor demand and institutional commitments. So the volatility again is important because the more you can prove that there is evidence on the integrity of the market in terms of accurate marketing, precise disclosures, then the market can grow. When markets are expanding, vague claims may slide by, but when markets are stressed, scrutiny in this case intensifies. Now, even though these flows are shrinking, and I'm gonna again pause for a second because there's another question in the poll. So even though some of these inflows are so they're being reduced, the interest on sustainable investing hasn't slowed down. A popular indicator for the increased awareness of ESG factors is the rapidly growing list of signatories to the Principle for Responsible Investment. PRI is one of the major organizations providing frameworks and guidance to investors who are actively seeking to incorporate ESG factors in the investment decision making. And as seen in the bottom of graph, the PRI now currently counts over 5,000 signatory investors. And these investors represent assets under management in both public and private markets. And this pool of assets has grown from less than $6 trillion to over 120 in 2025. This reflects institutional adoption, and PRI is influential because it represents a shared set of responsible investment principles. Um, and if there's some insights there is that signing these principles for investors, it's not just symbolic. It does create stakeholder expectations. It creates potentially a reputational exposure and sometimes contractual exposure depending on the representation that's being made to clients. So again, this is another example of this broader theme that commitments eventually will require evidence. Okay, so now I'm going to move to a timeline where I wanted to add, and there's some sources on the slide that we're going to share as well. Some of key, I would say, regulatory timeline events for the last 5 years, so that you can see a little bit how things have evolved. And I'm going to walk you through it year by year. I'm not going to focus on the technical details. To be honest, I don't know all the technical details there, but on what changed in terms of expectations. So in 2021, the key event was the EU Sustainable Finance Disclosure Regulation. And there was this level one, which is kind of like the basic format of that. This is a pivot point because this introduced structured sustainability disclosures for financial market participants in Europe. Now, the interesting part here is that the effect isn't limited to Europe because global asset managers distribute into Europe and because EU standards often influence global norms. So if you have exposure to Europe, you need to comply. And that is a key event there. In 2022, we had a couple of key events. In the UK, we had the Task Force on Climate-Related Financial Disclosures. And these were expectations for companies that move toward mandatory requirements. And in the US, we had the Department of Labor clarifying that ESG factors can be considered within fiduciary duties under the Employee Retirement Income Security Act. And that was very important at the time because it signaled legitimacy in a space that had a lot of political controversy. Now, in 2023, the ISSB, the International Sustainability Standards Board, issued under the FRS Foundation a and the standards S1 and S2. And that matters because it begins to form a global baseline. And meanwhile, the CSRD, and there's so many acronyms there, the Corporate Sustainability Reporting Directive and the European Sustainability Reporting Standards expanded mandatory reporting scope in Europe. And the SFRD, the standard that you saw in 2021, has now a level 2. So they're adding more detailed templates and more technical requirements. So their scope and granularity is increasing. In 2024, we have, even though the SEC climate rule has faced litigation and uncertainty, the key point there is that regulators are attempting to standardize climate disclosures for investors. In the UK, we have the SDR, the Sustainability Disclosure Requirements, that introduced anti-greenwashing rules and product labels that directly constrain marketing. And the EU Green Bond Regulation increased rigor in sustainability labeling in the debt markets now. So you see, there's a lot about labeling and the definitions and what sits behind a product if a claim is made. Then in 2025, the International Standard on Sustainability Assurance 5000 is issued. This is a signal that sustainability assurance is being formalized in a way that looks a lot more like audit and assurance practice. Um, the SEC withdrawal of proposed ESG fund rules shows a little bit of fragmentation there and shows also that regulatory direction is not uniform globally. In 2026, we have an SEC rule that actually affects ESG, the SEC names rule compliance. This rule requires funds to adopt 80% investment policies for names suggesting specific investments or characteristics. So if your fund has the name ESG or growth or value, then your investment policies need to go hand in hand with what your label is. And naming and labeling rules matter because they do transform marketing into compliance. And taxonomy updates show that classification systems are still evolving, which means organizations must design for change rather than treat compliance as one and done. And the big message here is, again, that regulatory environment is moving towards testable claims and assurable information. But of course, the global trajectory is a bit fragmented, which increases the complexity and the risk we're having here. Now, this slide, I wanted to capture this core transformation. I think that what historically sustainable was often, when historically sustainable was often treated as a product characteristic, like what we would say as growth or quality. But unlike those terms, it implies ethical, environmental, or social claims that investors may interpret as factual promises. And over the last 5 years, regulators and standard setters have pushed the markets to treat these claims more like regulated disclosures. So this shift has three consequences. Number one, definitions are tightening, and managers now are increasingly cautious about what they call sustainable because overbroad claims create exposure. This is why some markets, again, going back to the flows that I was showing you, this is why some markets show declines in sustainable assets under management. Definitions got stricter. Second, very important, enforcement focus is intensifying. Greenwashing has become a central driver of enforcement, and greenwashing is often not about lying blatantly. It's about overstating process rigor, implying exclusions that aren't happening, they're not real, claiming some sort of systematic integration that is not systematic, or presenting metrics and data without sufficient controls. And third, we have assurance moving into picture. Once investors and regulators require higher confidence, assurance follows. And assurance does require control processes, it requires evidence, it requires governance and clarity of criteria. So in practical terms, organizations are being pushed to treat sustainability information the way they treat financial information as something that must be defensible. And I got some highlights about real events that have happened in terms of greenwashing and litigation and people losing actually their jobs over these events. Um, Now, staying within again this whole story of litigation and especially on climate change, this slide highlights sorry, the rapid growth of climate change litigation globally. Over the past few decades, legal action has become an increasingly important tool for addressing climate-related responsibility and accountability. If we look back to the late 1980s, climate litigation was very rare. However, the number of cases has accelerated sharply in recent years. According to UNEP's litigation reports, the total number of climate-related cases increased from 800 in 2017 to over 2,000 cases by 2022, and the latest figures show that this trend is upward through 2025. And we're seeing actually several categories of these cases emerging. First, we have disclosure-based litigation, where plaintiffs argue that companies misrepresented climate risks or overstated sustainability commitments. These cases often resemble traditional securities litigation but focus on climate statements. And then we have strategic climate litigation, where governments, NGOs, or investors they seek to force companies to change behavior. For example, by aligning operations with climate targets. And then we have fiduciary duty claims, where investors argue that boards or asset managers failed to adequately consider climate-related financial risks. Um, Actually, in the US, we also have the opposite, where they do consider financial climate-related financial risks, and then the argument is that they shouldn't. Again, making this topic a little bit political there. But the key takeaway is that climate claims are no longer just reputational statements. They're increasingly treated as legally testable assertions. Another point also is that climate litigation is not limited to a few countries. The number of jurisdictions involved has expanded significantly, showing that climate-related legal disputes are becoming a global phenomenon rather than a regional one. Um, the United States actually represents a large share of cases, but the fastest growth is occurring outside the US, where a lot of courts in many countries are increasingly being used to challenge governments and corporations on climate commitments, environmental damage, and emissions reductions responsibilities. Um, I do think this is an important shift because climate governance is not only driven by policy and regulation. Now we have courts becoming a central arena almost for climate accountability and shaping how companies respond to climate change. Sorry, there's another quick poll. Um, okay, so I tried to in the next two slides summarize a few implications. I hope I'm not misrepresenting those implications. You guys are the professionals that know much better than me. But um, what can we take from out of this for CPAs and attorneys? What are some of the key points that we can make? And this is where if we start talking about CPAs, where we translate the evolution into accounting and assurance reality. The first point is on this slide is important because even when sustainability reporting is considered non-financial, sustainable investing increasingly changes financial statement judgments and investment valuation support. So let's start unpacking this with four accounting lenses in a way. One is this idea of fair value measurement. When you measure fair value, you use market participant assumptions and expected future cash flows. And over the past 5 years, markets have started increasingly pricing in sustainability risk and transition risk in certain sectors. I'm focusing on some of the environmental topics more than the social ones, but in some cases they have equal, if not more, gravity. This can influence discount rates, cash flow assumptions, liquidity assumptions, or even terminal values. So if, for example, a company faces credible transition risk, carbon cost, demand shifts, that risk may affect expected margins or CapEx needs. And these expectations can affect valuation. So the CPA implication is not, oh, ESG is another valuation model or something separate. It's actually ESG drivers increasingly influence existing valuation inputs. And when a fund claims sustainable strategy, the accounting and control question becomes, does the portfolio actually reflect the stated criteria? Because if not, then there may be a misstatement risk in disclosures, and the reputational risk can become financial risk. Then if we move on to impairment and useful life, impairment testing depends on indicators and future cash flows. So climate transition can create impairment indicators, regulatory restrictions, declining demand for high carbon products, stranded assets. Physical climate risk can influence asset utilization, repair and maintenance costs, and we've seen this with extreme weather events, insurance availability, even worse in some cases in terms of extreme weather events. So CPA should be asking, are climate-related risks considered in cash flow forecasts used in impairment tests? Are assumptions that are being used consistent with what we see in terms of public sustainability disclosures? Um, Again, because inconsistency between disclosures and accounting assumptions can become a problem. And then provision contingencies. Climate litigation and regulatory enforcement have expanded, as we've seen. Even if sustainability disclosures are not in financial statements, they will influence probability assessments, measurement of provisions, and contingencies. So if you made those commitments publicly and you fail to meet, it could trigger regulatory action. And then the financial instruments credit risk side, banks, lenders, credit investors are increasingly incorporating ESG variables into credit risk models. And there's a lot of research around this topic. And this can affect maybe credit losses, underwriting standards, collateral valuations. And this slide, the idea is to emphasize the controls and evidence and make it a little bit more operational. So if you are a CPA in advisory role or assurance role, you'll see more convergence in terms of controls that you have to have in place, data and governance with sign-offs and escalation protocols. Um, Now, if you are a CPA advising a company or an asset manager, again, talking about the controls and evidence, the readiness questions would be like, what is the reporting boundary? What are the criteria? Who owns the data? What controls exist? Can you evidence what methodology we're using? Do you have audit trails? So the direction of travel is that sustainability information is becoming more assurance ready. And again, we talked about a little bit about the assurance readiness and the ISSA 5000 that is becoming more formalized. Um, Now, if we switch gears and talk a little bit about implications for attorneys, and again, this spans multiple fronts, and I try to organize it into some key categories that made sense in my mind, which is disclosure regimes, greenwashing liability, and then the naming, marketing constraints, and contracting governance. Um, so disclosure regimes drive legal risk across jurisdictions. And we have some of the acronyms that I mentioned, the EU SFDR, the CSRD, the ESRS, the EU, the UK TCFD and SDR, and US state level regimes. And the central challenge, I would say, for attorneys is this cross-border inconsistency. So you have EU obligations for product disclosure, UK obligations for anti-greenwashing, US obligations that depend on state law, federal enforcement posture, and litigation risk. So the legal review becomes not just is the statement accurate, but is it accurate under all these definitions and expectations of each jurisdiction. Fun times for lawyers, it looks like. Um, and then if we talk about the greenwashing part, this risk shows up in several legal forms. So you have regulatory enforcement actions, you have consumer protection claims, securities fraud litigation, shareholder claims, contract disputes with institutional clients. And again, these greenwashing cases, I think I mentioned this before, it's not about fabricated data always. It's also about the rigor with evidence, inconsistent application of the processes, exceptions that were not disclosed, governance failures. So you could have the extreme cases, let's say some sort of Volkswagen type of scandal where the data is fabricated, but you can have other cases that's still being litigated. So sustainability language in this case has to be treated like regulatory disclosure language, not aspirational marketing. Um, and then if we think about contracting and governance, sustainable investing commitments increasingly appear in investment management agreements, side letters, representation and warranties, indemnities, board charters, escalation protocols. From a legal risk management standpoint, the best practice is to ensure that an organization does have clear definitions, does have control processes to implement them, and does have board level oversight frameworks. Because, again, if a dispute arises, regulators and courts will look for evidence of governance. Um, so, just to close this, I have in my mind five practical conclusions. If you keep something out of today's presentation, number one is that sustainable investing is not just an investment philosophy; it's a compliance environment, or at least it's becoming a compliance environment. The second one is, and probably you heard me say this many times, definitions do matter. Ambiguity is not your friend in this case, and precision reduces risk. Third, we see a shift towards evidence in terms of policies, procedures, and demonstrable alignment. Fourth, assurance is coming fast. And if sustainability information is not governed like financial information, assurance will be painful and high risk and probably very expensive as well. And I think last but not least, I think on the positive note, I think CPAs and attorneys can and should collaborate in this space because finance teams must understand disclosure risk, legal teams must understand data lineage and operational reality. So there's a world where the two worlds come together. Um, so just to close it, sustainable investing has become a regulated claim, and regulated claims do require proof. And with that, thank you for the attention and bearing with this presentation. I know there was a lot to unpack in this context, and happy to take any questions if I can answer them.
Takis, thank you so much. I learned a great deal, and I think it's incredible how the complexities really refine the risk and the opportunities. So they're really there for all of us. I'm going to open it up for questions. When I do that, I am also, however, going to put a link in the chat with our YouTube channel for SILC masterclasses. Feel free to reference Sakis's course, which we will upload. And there are two prior courses. And if you would like credit for the prior courses for our certificate, you can send us an email, which is also in the chat. So with that, let me open it up to questions from our audience. You can either type it in the chat or go ahead and um, raise your hand or come off screen. I will start with a question. Sakis, I'm interested in your prediction on how the U.S. changing framework from it's sort of everyone's doing it to now it seems the companies that want to do it are doing it, and it's a bit limited, but of course there's a lot of different definitional changes. How do you think the U.S. is going to impact, in particular, the market for assurance and some of the opportunities and the need for collaboration among attorneys and accountants?
So and again, this is coming as a data point of one, so take it in terms of like my personal opinion. Even though you've seen that in the US, some of the regulations that were put forward have not gone forward, in a sense, it doesn't matter. This is an industry that overextended very fast and it had a natural slowdown, as with any industry that faces kind of like a plateau. So even if it wasn't so much pushback from the US, it would have happened naturally. A climate related, I'll focus on climate, but we can touch on social issues. Climate related events are here to stay. The emergence of AI and the data centers and the need for energy and water that comes together with that will actually accelerate some of the reporting around what are we doing, where are we getting that energy, how is it, how are we distributing across the world. So what I feel is that again, the rest, non-US world, we've seen a great traction from Asia, primarily in Japan, and other Asian countries that are trying to take the lead now. So in essence, what I'm trying to say is that the market will still grow, and there is a big push to financial standards regulators like the IFRS to keep um, pushing forward with bringing sustainability in the financial statements. There is also the emergence of impact accounting, where you take sustainability issues and you report them in the same format with financial accounting with the same unit. So you basically monetize impacts. And that will require, of course, assurance because you literally have it in a financial statement. We have actually large publicly listed companies that do so. So they have in their financial statement non-financial, as they call it, or ESG data, expressed in monetary figures. So the assurance market, in a way, will grow as a requirement to validate that information. So again, there's turmoil, and of course we've seen it on the outflows of the funds, but that doesn't mean that this industry is gone. It just means that there's a natural consolidation, but some of these topics are definitely here to stay.
Thank you. We have a couple just questions in the chat. The first one is, how extensive is greenwashing out there?
Very, it's crazy. So it's incredible. So there's two aspects to this. There is the corporate aspect and there is the investor aspect. So on the corporate aspect, it was mostly mislabeling products. So there's actually a case right now in the European Union against airlines and all these. I don't know, probably you've seen it when you fly. You get this option to offset your emissions, and it was pretty much nonsense. So they weren't actually doing anything to offset emissions. And the regulator came in and they said, all of these claims, there's no valid argument on how you're calculating how many emissions you're offsetting and what you're doing and what you do with carbon credits. So you had corporates using these sustainability labels to get consumer interest because consumer interest were spiking. And then you had from the investor side a lot of funds that would say we're a sustainable fund, and what they would do is they would literally just have a negative screen against the whole sector. The easiest one to exclude was tobacco. The sector, in terms of how big it is small, just a handful of companies. So it was very easy tick box exercise. Um, that actually compromised the legitimacy of the whole ESG space because people coming from the outside are like, oh, yeah, it does make sense, right? What are you guys doing there? And that's why, again, you probably I overtired the audience with me going on and on about definitions, but definitions do matter. And once regulators come in and they say, no, here's what we mean with sustainable, and if you say that you implement ESG integration, show us, then it's a smaller market, but it's a market that actually does what they're supposed to do. So the greenwashing was very extended. Again, you can follow the story of the CEO of DWS that had to resign because there were serious allegations of greenwashing. So massive German asset management firm, and serious consequences there. So yeah.
Great. Thank you, Sakas. We have a few more questions coming up. The next one of the battlefields in the US is around ESG funds and 401k plans. Is there a way to include ESG funds on risk return merits? While the recent track record is poor, we can argue that there is also the case for value investing.
Correct, correct. So here's an interesting fact. If we go back to this, as we said, there's this greenwashing aspect that a lot of funds that shouldn't be classified as sustainability funds were. If you now take the subset of funds that should be classified, and there's a lot of research there, academic research as well. I can actually send you materials. These funds outperform the market. They have traditionally outperformed, and again, you don't look at it at a horizon of 1 year, you look at it at a 20 years horizon, and they actually do well. So from a returns perspective, they do pretty good. So the argument would be why not invest in it? Unfortunately, in the US, this topic has been very politically driven, the conversation. There has been a lot of effort around what happens with 401k plans and try to include ESG funds there. There has been a lot of arguments about fiduciary duty and the idea that it's uh, basically profits first and a return on investment rather than social and environmental impacts. And the counterclaim was that social and environmental impacts go hand in hand with returns. This topic has gone back and forth. I like how you called it a battlefield because this is exactly how it is. Uh, we're still we're still optimistic. As you can imagine, I'm a believer in the space, so we're still optimistic that one day the, fund, the pension plans will be able to use ESG funds without being worried for litigation coming out of nowhere or them losing their jobs. Uh, but again, I would say that if we eliminate this greenwashing aspect, then the track record of those funds will actually show that they're doing quite well. And sorry, last point, if you see clean tech funds in the last year or so, they're killing it. Even though there has been pushback, even though a lot of the credits they were getting have been revoked, they're actually doing quite well. So some of the numbers are there.
Great. Thank you. Okay, our next question. What are some tools or accounting models for organizations to utilize sustainability reporting to drive additional profit, either revenue or cost management or other financial channels?
So there are a couple of leading frameworks on how to think about sustainability reporting going hand in hand with financial value. Because again, sustainability started as an exercise. We report a whole bunch of issues that could affect the company, but the reality is that some of them are more or less financial material. So, two frameworks that I would look at or I would recommend to have a look at is one is the Sustainability Accounting Standards Board framework, which is basically a way to per sector. And if you think of this as a matrix where on the left hand side you have environmental, social, and governance issues, a whole laundry list of them, and kind of like at the top you have different sectors and industries. This gives you a framing on what are the 5, 6 key topics that you should look at if you are a software company versus a mining company versus a healthcare company. So it frames the discussion and it's not a laundry list of 100 different issues. You narrow it down to 5 and then you start thinking about value levers and value drivers. How does this issue connect with costs, or how does this issue connect with revenues? Does it or does not? So this gives you that you call it a tool, which is exactly what it is. It gives you a way to connect a business model with sustainability issues and hopefully find those efficiencies to drive revenues or cost management. And the other one, again, it's a little bit selfish from my side because I'm involved in the space, is the whole idea of impact accounting. Not only to think about ESG issues, but actually put a value on them. Because the problem, one of the problems that we're having is that when you talk about environmental and social issues, if I say like 1,000 cubic meters of water withdrawn, somebody might say, I have no idea how much is this. Is the size of a building? Is the size of a room? Is it bad, and how does that compare with tons of CO2 emissions and supply chain accident somewhere in a developing country? So these are not easy to compare and contrast. And what the idea of impact accounting is, similar to financial accounting, is to take this and say, okay, what is the price of 1 ton of CO2 or of 1,000 cubic meter of water withdrawn? What is this externality? How much should we pay for it? And then you bring this all to financial statement and say, okay, I create, let's say, this amount of revenues, but at the same time, I have this cost that I'm not paying for in dollars. But if they were to be internalized tomorrow, this is money that I'm going to lose off my balance sheet. And how do they get internalized? It could be a carbon tax, it could be consumer preferences. In the UK, for example, they launched last year a sugar tax. So if you were a food company and you had a lot of sugar on your product, suddenly you lost money because you had to pay for it. So these are the way some of these externalities get internalized. And if you don't know the dollar figure, it's really hard to connect them to revenues or costs.
Great, thank you. We have another question. Carbon credits and markets are a whole other level to discuss, a whole nother topic, but certainly it's a key area worth deeper inquiry. What other areas are worth a deeper look in addition to carbon credits?
Interesting. So no, I agree with you in about carbon credits and markets. There's a lot of criticism and skepticism about the markets. So it's a whole session we can do on that. The other areas I would say, so what I have seen is there is a massive push now to what they call thematic investing within ESG. So, and it goes back also to the first argument, actually your question, Andrea, about the shift in the US regulatory policy. So what I have seen is now we don't call it ESG anymore because we won't comply with the narrative and the language, and we start calling it a theme. So we can say health and well-being or transition, or again, it could be artificial intelligence, and within that you start investing in data centers that are powered by alternative energy or renewable energy. And that I feel is a very interesting area to look at how this language of ESG has shifted to accommodate for problems that we have within thematic investing and how companies, both public and private, and investors start deploying capital across those themes. And there are two or three very, very big ones that have emerged the last few years. And again, I'm not going to be surprised if all this talk about labeling of funds and disclosures start covering this thematic approach and looking more closely as to what these funds are doing and what these companies are doing.
Great, thank you. Excellent questions. Thank you from the audience. Any last questions for Sakis? Okay. I want to thank the audience. I want to thank you, Sakis, for some really
Thank you.
interesting discussion here. There's a lot to work with. It's exciting. I think it's a very exciting time to be in this area, in this field. We are going to be sending out a course review for folks who attended today. And keep in mind our YouTube channel, which you can reference this presentation. And I really want to thank you all for attending, and to Sakis for leading our today's Silk Masterclass. So wishing you all a wonderful, safe, and sustainable day. Thank you so
Thank you.
much.
Bye.
Bye.